The trade that damages you most is often not the one that loses money, but the one that teaches you to stop trusting yourself. You enter with a plan, watch price move against you, adjust the plan to protect your pride and call it judgment. Then, when the market finally proves you wrong, the loss feels larger than the number on the screen because something quieter has been spent discipline. This is where the real contest begins. Not at the entry, not at the exit, not even in the analysis. The market does not merely test whether your idea is correct. It tests whether you can remain stable while uncertainty attacks your need to be right. A trader can study patterns, volume, trend range, support, resistance, earnings, news, and sentiment, and still fail for one reason. He interprets market movement through the condition of his own nerves. A small pullback becomes a threat. A missed move becomes an insult. A winning trade becomes permission to loosen his standards. A losing streak becomes evidence that the market has turned personal. None of these interpretations come from the chart. They come from the trader. That is why psychological resilience is not a soft idea. It is a practical market tool. It determines whether you cut the loss when the premise breaks, or wait until pain forces you out. It determines whether you add to strength with purpose, or chase movement, because someone else is profiting without you. It determines whether you sit still when there is no trade, or invent one because silence feels like failure. You must learn to notice the moment your mind begins negotiating with price. When you say, "I will give it just a little more room," ask whether the market has changed or whether your fear has become clever. When you say, "I knew this would happen," after hesitating on a valid setup, ask whether you wanted confirmation so badly that you demanded certainty from a business that never offers it. When you feel the urge to recover today's loss before the session ends, understand the danger. You are no longer trading the market. You are trading your emotional balance sheet. Markets punish confusion because confusion creates delayed action. They punish arrogance because arrogance creates oversized risk. They punish hope because hope holds positions after the evidence has changed. And they punish excitement because excitement makes ordinary movement feel exceptional. The trader who survives is not the one who feels nothing. He is the one who does not obey every feeling. This requires a different kind of attention. You study price, yes, but you also study your reaction to price. Does your breathing change when a position moves against you? Do you read the chart differently after 2 losses? Do you become more certain after a win, even when the next setup is weaker? These details matter because behavior compounds. A small emotional compromise repeated over time becomes a trading identity. The market's warfare is quiet. It rarely announces itself. It enters through impatience, through the need to act, through the discomfort of waiting, through the desire to be proven right quickly. And if you do not recognize these pressures while they are still small, they begin making decisions in your name. The market often wounds a trader before it takes his money. It does this by making him believe that a price movement is saying something about him. A trade moves against you, and suddenly it is not just information. It becomes disrespect. A position hesitates, and you feel accused of being early. A stock runs without you, and the move feels like a judgment on your hesitation. That is where the first battle begins. Price is not speaking to your pride. It is not aware of your entry, your doubt, your effort, or your need to prove yourself. It is only the result of pressure meeting pressure. But when you attach personal meaning to that movement, you no longer see the market clearly. You begin to defend yourself against something that is not attacking you. And a trader who is defending himself cannot observe properly. This is one of the quietest dangers in speculation. The chart may not change, but your interpretation of it changes because your emotional condition changes. When you are confident, the same weakness looks temporary. When you are afraid, the same weakness looks fatal. When you are frustrated, ordinary movement feels like manipulation. When you are eager, thin evidence looks convincing. The market has not become clearer or more dangerous. You have become easier to influence. You must understand this carefully. Emotion does not ruin the trader simply because he feels it. Feeling fear, irritation, regret, or excitement is not the failure. The failure begins when the feeling becomes the lens. Once that happens, you stop asking, "What is price showing?" and start asking, "What does this mean for me?" That small shift changes everything. It turns analysis into self-protection. A trader who feels embarrassed by a losing position will search for reasons to remain in it. Not because the evidence is strong, but because closing the trade feels like admitting something about himself. A trader who feels left behind will see opportunity where there is only motion. Not because the setup is sound, but because missing out feels intolerable. A trader who feels clever after being right once may begin to see confirmation everywhere. Not because the market is offering it, but because confidence has become hunger. This is why psychological resilience begins with interpretation. Before discipline can hold, before patience can matter, before judgment can sharpen, the trader must stop confusing market information with personal meaning. A red candle is not humiliation. A failed idea is not a character flaw. A missed trade is not a verdict. These things may cost money, but they become dangerous only when they begin to cost identity. The market has a way of exposing whatever you secretly need from it. If you need approval, you will overvalue being right. If you need relief, you will rush decisions that end discomfort. If you need excitement, you will mistake activity for opportunity. If you need revenge, you will look at the next trade as a repair mechanism. None of these needs belong on the chart, but once they enter the trade, they distort everything you see. So your first work is not to suppress yourself. It is to observe yourself with the same seriousness you give to price. Notice when your language changes. "This should go up. They are shaking me out. I cannot miss this." It has to turn. These phrases are not analysis, they are clues. They tell you that your mind may be trying to turn uncertainty into a story it can tolerate. When you catch that happening, create distance. Do not argue with the emotion. Do not obey it either. Name what is present: fear of being wrong, desire to recover pride, irritation at waiting, hunger to be included. Once named, the feeling loses some authority. It becomes an object you can examine rather than a force that moves your hand. The resilient trader is not colder than other traders. He is more honest about what is happening inside him. He knows that the market does not need to defeat his system if it can first disturb his interpretation. Once interpretation bends, the rest of the process becomes vulnerable. And after you have learned to see the difference between price and personal meaning, the next test arrives: whether you can act correctly before comfort gives you permission. The moment that separates a trader from his plan is usually very small. It is not dramatic. It is the pause before entering when the setup is present, but the outcome is still unknown. It is the delay before cutting a trade when the signal has failed but hope is still breathing. It is the few seconds where you know what your rule says, but you wait for the feeling to become easier. That waiting is expensive. Not because patience is wrong, but because this kind of waiting is not patience. It is a search for emotional permission. The trader tells himself he is being careful, but often he is only asking the market to remove uncertainty before he acts. The market does not do that. It may give evidence, but it does not give comfort at the exact moment comfort is most desired. Execution means acting when the condition is met, not when the nerves are settled. This is simple to say and difficult to live. Before the trade, the setup looks clean. After the trigger appears, the mind begins to ask for one more candle, one more confirmation, one more sign that failure is unlikely. But every extra demand changes the trade. The entry becomes late. The stop becomes wider. The reward becomes smaller. A good idea is turned into a poorer trade because the trader wanted certainty before commitment. The same problem appears when the trade is wrong. The evidence changes first. Acceptance comes later. If you wait for acceptance, the loss has more time to grow. You may know the trade no longer deserves your capital, yet the hand does not move. That delay is not analysis. It is discomfort looking for a reason to stay still. In execution, seconds can become dollars, and dollars can become damage. You must learn to respect the difference between hesitation and restraint. Restraint is planned. Hesitation is improvised. Restraint says, "No trade, because my conditions are not present." Hesitation says, The conditions are present, but I do not feel ready. One protects you from poor action. The other protects you from emotional pressure. They may look similar from the outside, but inside they are opposite forces. A trader who cannot execute begins to lose trust in himself. Each time he fails to act on valid evidence, he teaches his mind that rules are negotiable under pressure. Then, when the next trade arrives, the rule carries less authority. The plan becomes a suggestion. The suggestion becomes a debate. And once the trader is debating with himself in the middle of movement, the market has gained the advantage. This is why execution must be decided before the moment of execution. You cannot expect calm judgment to appear suddenly while price is moving and money is exposed. The work is to make the action almost mechanical when the evidence appears. Not careless, not blind. Mechanical in the sense that you already know what must happen if the condition is present. You should not be surprised by discomfort. Expect it. When the entry comes, expect uncertainty. When the exit comes, expect resistance. When the trade starts working, expect the urge to interfere. These feelings are not instructions. They are weather around the decision. If the action depends on the weather clearing, you will often act too late. So give the market fewer chances to bargain with you. Define the action before the pressure arrives. Know what must be seen, what must be done, and what must not be reconsidered in the heat of movement. Then, when the moment comes, do not ask whether you feel ready. Ask whether the condition is present. This is the discipline of execution, the willingness to move while uncertainty is still alive. But execution alone cannot carry a trader if the size of the risk is already too heavy for the mind to bear, and that is where the next layer of resilience begins. A trader often thinks fear begins when price moves against him. It usually begins earlier when he chooses a size that his mind cannot carry. The chart may still be calm, the trade may still be within its normal movement, but inside, pressure is already rising because the number at risk is too large for clear thought. This is the part of trading that pride tries to avoid. A position is not only a market opinion, it is a psychological weight. If the weight is too heavy, every tick becomes louder. A small move against you feels urgent. A normal pause feels dangerous. A routine fluctuation begins to look like a warning. The market has not changed character. The trader has changed capacity. Mathematics is what keeps that capacity honest. Risk per trade, position size, distance to the stop, expected reward, loss limits, win rate, and average outcome are not cold details. They are the structure that protects the mind from panic. When the numbers are loose, the trader must use willpower to survive every trade. When the numbers are sound, the trade is allowed to breathe without forcing the trader into emotional emergency. You must never confuse confidence with risk tolerance. Confidence says, I believe this trade can work. Risk tolerance asks, what happens if it does not? A trader who only answers the first question is exposed. He may be right about direction and still trade so large that a temporary move breaks his judgment. The market does not need to prove him wrong. It only needs to move enough to make him unstable. This is why oversized trading is so dangerous. It changes the meaning of ordinary loss. A manageable loss is information. An oversized loss becomes an event. Once a loss becomes an event, the mind begins to protect itself rather than follow process. It wants relief. It wants rescue. It wants the next trade to repair the last one. The original mistake was not emotional weakness. The original mistake was numerical excess. Proper risk does not make losing pleasant. It makes losing usable. There is a great difference. If one loss damages your confidence, your size is teaching you fear. If 2 or 3 losses make you abandon your method, your numbers are not aligned with reality. A trading approach must be able to absorb its normal losing sequence. If it cannot, then the problem is not merely discipline. The problem is design. Think in sequences, not single trades. One trade can deceive you. A single winner can make poor risk look intelligent. A single loser can make a sound method feel broken. But a sequence reveals whether your mathematics can carry you through uncertainty. If your plan depends on the next trade working, it is not a plan. It is pressure dressed as conviction. This is where expectancy matters. A trader must know what his method is trying to earn over many attempts, not what he hopes to take from the next one. If the average win is too small compared to the average loss, the mind will eventually feel the imbalance. If the win rate is modest but the trader expects constant accuracy, frustration will follow. If the drawdown is normal for the method but unexpected by the trader, he will treat normal pain as failure. Numbers prepare the mind by removing surprise. You should know what a full loss costs before the trade opens. You should know how many losses in a row are possible without threatening your capital or your composure. You should know whether the reward justifies the exposure. When these figures are unclear, imagination fills the gap, and imagination under pressure usually becomes fear. The resilient trader does not use mathematics to predict every outcome. He uses it to make every outcome bearable. He accepts that uncertainty cannot be removed, so he measures it, limits it, and places it where it cannot command him. This gives him the freedom to see the trade as one event in a long series, not as a personal test that must succeed now. And once the numbers have made the mind steadier, the trader can begin to look outward with greater clarity, because the next battle is not inside the position size, but in understanding how the market itself moves, traps, pauses, and reveals pressure. The market does not move because you are ready for it. It moves when enough pressure has gathered on one side and enough weakness has been found on the other. That is why a clean-looking opportunity can fail and an ugly-looking move can keep going. Price is not trying to be fair. It is searching for orders. This is a hard truth for a trader to accept. The market often looks most inviting after the easy portion has already passed. A strong advance draws attention because it is visible. A sharp decline creates urgency because it is painful to watch. But visibility is not the same as opportunity. By the time the crowd feels certain, the market may already be approaching the place where late buyers become fuel for sellers or late sellers become fuel for buyers. Markets move through participation. First, there is quiet preparation. Then there is recognition. Then there is pursuit. The early movement is often ignored because it lacks drama. The middle movement begins to attract serious attention. The late movement attracts emotion, headlines, and urgency. If you do not understand this rhythm, you will mistake public excitement for confirmation when it may only be evidence that the move is becoming crowded. This is why breakouts, reversals, pauses, and shakeouts must be read as behavior, not as isolated shapes. A breakout is not important because a line was crossed. It is important because it shows whether new demand can hold above a previous area of supply. A reversal is not important because price changed direction once. It matters because it reveals whether the side that was in control has lost the ability to continue. A pause is not dead movement. It may be absorption, hesitation, or preparation. The inexperienced trader wants price to move cleanly. The market rarely grants that wish. It tests levels. It draws in weak commitment. It pushes beyond obvious places because obvious places collect orders. Stops, breakout entries, failed breakdowns, crowded highs, and emotional lows all become areas of fuel. The market does not need to know who is there. It only needs the orders to be there. When price runs quickly into an obvious level and then stalls, that stall is information. It may show that the move has spent too much energy reaching the level. When price breaks lower and quickly recovers, that recovery is information. It may show that sellers found no follow-through. When price rises on excitement but cannot hold its gains, that failure is information. It may show that demand was urgent but not durable. You are not looking for certainty in these behaviors. You are looking for evidence of control. Who is pressing? Who is failing? Who is trapped? Who is forced to act next? A market under accumulation often refuses to stay down, even when news appears poor. A market under distribution often refuses to advance, even when the surface looks strong. The important question is not whether the story sounds convincing. It is whether price accepts or rejects that story. This is where patience becomes a form of observation. Not the patience of doing nothing out of fear, but the patience to let behavior reveal itself. A single candle can deceive. A single reaction can exaggerate, but repeated failure at the same area, repeated recovery from weakness, or repeated inability to hold strength begins to show character. The market leaves traces of pressure before it gives the larger move. You must learn to watch how price behaves after it does something obvious. After the breakout, does it hold? After the breakdown, does it continue? After the sharp rally, does supply appear? After the sudden drop, do buyers return? The reaction after the event often tells more than the event itself. The first move attracts attention. The second response reveals conviction. This understanding keeps you from treating every move as equal. A fast move on thin participation is different from a steady advance that absorbs selling. A violent drop into support is different from a slow grind that shows persistent supply. A failed high after heavy enthusiasm is different from a quiet pullback in a strong trend. The structure gives context to the movement, and context gives weight to judgment. But even when the market begins to reveal its behavior, you still face the harder task, choosing what to do with incomplete information before the picture is fully settled. A trader rarely suffers because he had no choice. He suffers because he had too many choices at the moment pressure arrived. Buy now, wait, reduce, reverse, hold, ignore, recheck, ask for another signal. The mind opens too many doors, and while it is walking through them, the market keeps moving. Decision making in markets is not the art of knowing everything. It is the art of knowing what matters enough to act. You will never have complete information. There will always be another indicator, another opinion, another headline, another warning, another reason to delay. If your process depends on perfect clarity, the market will keep you trapped between action and doubt. This is why strong decisions must be narrowed before they are needed. A clear trader does not enter the pressure of the moment asking, "What could happen?" Anything can happen. That question expands confusion. He asks better questions. What is my premise? What evidence supports it? What evidence would weaken it? What action is required if that evidence appears? These questions do not predict the future. They reduce noise. The weak decision is often built on scattered attention. A trader sees one piece of evidence in favor of the trade, one piece against it, then adds emotion, memory, recent results, and outside opinion into the same room. Soon he is not weighing evidence. He is collecting impressions. Impressions feel intelligent because they are active, but they rarely produce clean action. They make the trader feel informed while leaving him undecided. A sound decision needs a hierarchy. Not all information deserves equal weight. The broader condition may matter more than the last candle. The quality of the setup may matter more than the speed of the move. The invalidation point may matter more than the desire to be early. When you do not rank evidence, the most emotional piece of information becomes the loudest, and the loudest evidence is not always the most important. You must also know the difference between a decision and a reaction. A decision is tied to a condition. A reaction is tied to stimulation. Price jumps, and the reactive trader feels pulled. Price drops, and he feels pushed. He is not choosing from a prepared framework. He is answering movement with impulse. The market can control such a trader because every fluctuation becomes an instruction. A decision framework gives you distance. It says, if this condition appears, I will consider this action. If it does not appear, I do nothing. That may sound simple, but it is one of the few protections a trader has against inner noise. The point is not to become rigid. The point is to stop reconsidering your entire philosophy every time price moves. This is especially important when information is mixed. The market often gives partial evidence. Strength appears, then hesitates. Weakness appears, then recovers. Momentum improves, but location is poor. The inexperienced trader treats mixed evidence as an invitation to guess. The disciplined trader treats it as a reason to reduce the decision, not expand it. Sometimes the correct decision is not buy or sell. Sometimes it is not enough. There is power in refusing unclear decisions. Every trade you avoid preserves attention for the one that deserves it. But refusal must be based on standards, not fear. If you avoid action because the evidence is incomplete, that is judgment. If you avoid action because any risk feels uncomfortable, that is avoidance. The market will not tell you which one is happening. You must know your own process well enough to tell the difference. Before each decision, force the matter into plain language. What do I believe is happening? What would prove that belief weak? What is the cost of being wrong? What action is required now, and what action is forbidden? If you cannot answer simply, you are not ready to place weight on the decision. The resilient trader does not worship certainty. He respects clarity. Certainty is a feeling that comes and goes. Clarity is a structure you can return to under pressure, and the trader who can make clear decisions in an unclear market begins to understand why the next battle is not only in the moment of choice, but in the habits that prepare that moment long before it arrives. The trading day does not begin when the market opens. It begins with the condition you bring to the screen. A tired mind sees urgency where there is none. An unprepared mind treats every movement as a surprise. A distracted mind mistakes noise for opportunity. By the time price begins to move, the trader has often already decided how difficult the day will be without knowing it. This is why professional habits matter. They are not decoration around the trading business. They are the walls that keep disorder from reaching the decision. A trader who arrives without preparation must use live emotion to solve problems that should have been settled earlier. He must decide what matters, where risk may appear, what levels deserve attention, and what kind of day may be forming, all while price is moving. That is not discipline. That is unnecessary exposure. Routine reduces the number of battles you must fight. When you review your watch list before the session, you are not trying to predict every move. You are deciding where your attention belongs. When you mark important levels, you are not claiming the market must respect them. You are preparing yourself to notice how price behaves there. When you define the conditions that would make a trade worth considering, you are removing the need to invent standards under pressure. The amateur often wants freedom. He does not want a routine because routine feels restrictive. But in trading, too much freedom becomes weakness. Without structure, every candle can invite a new opinion. Every headline can pull the mind away from the plan. Every sudden move can create a fresh temptation. The trader thinks he is flexible, but he is only available to distraction. A professional habit is useful because it makes certain errors harder to commit. A written plan makes impulsive action more visible. A risk limit makes emotional escalation less convenient. A post-trade review makes self-deception more difficult. A fixed preparation process makes random opportunity less seductive. None of these habits guarantees success, but they reduce the number of ways a trader can betray himself without noticing. You must also respect your physical condition. The market does not care whether you slept poorly, argued before the open, skipped preparation, or carried stress into the session. But your perception cares. Fatigue lowers patience. Stress narrows attention. Excitement increases speed. Poor condition does not always create an immediate mistake, but it lowers the threshold at which a mistake becomes likely. The professional does not pretend he is the same trader every day. He measures his condition before he trusts his judgment. This does not mean you need a complicated ritual. Complexity can become another form of avoidance. A strong routine is simple enough to repeat and serious enough to matter. What is the market environment? Where are the important areas? What names or instruments deserve attention? What conditions must be present before action is allowed? What risk is permitted today? What behavior would require stepping back? These questions bring order before pressure arrives. After the session, the work changes. The trader must examine not only what happened, but how he behaved while it happened. Did he follow the plan when nothing exciting appeared? Did he chase movement outside his preparation? Did he respect his own limits after a mistake? Did he change standards as the day became emotional? The purpose of review is not punishment, it is correction. What remains unexamined becomes repeated. Over time, routine builds trust. Not the loud trust that says every trade will work, but the quiet trust that says you know how you will conduct yourself. That trust becomes important when the market becomes active. Without it, pressure finds loose places. With it, the trader has something firm to return to. Restraint is easier when the day has been prepared. Patience is easier when attention has been assigned. Discipline is easier when limits have already been named. The professional does not rely on strength in the moment alone. He arranges the day so that strength has support. And once the trade is finally open, all of this preparation faces its sharpest test, whether the trader can manage a living position without allowing every movement to rewrite the plan. A trade feels different after it is opened. Before entry, it is an idea. After entry, it has a pulse. Every movement seems to ask for a response. A small gain invites protection. A small loss invites adjustment. A pause invites doubt. The position is no longer something you study from a distance. It is now alive in your account, and that changes the pressure. This is why trade management is its own discipline. The danger is not only being wrong. The danger is interfering with a trade for reasons that have nothing to do with the trade. You may call it managing risk. You may call it staying alert. But if every tick causes you to reconsider the entire position, you are not managing. You are reacting. A living trade must be judged by new evidence, not by new sensation. Price moving up is not always proof that the trade deserves more trust. Price moving down is not always proof that the trade has failed. The question is whether the reason for the trade is being confirmed, weakened, or left unchanged.